Welcome back to this disciplinary edition of Mad Money, where I'm doing everything I can to help beef up the disciplines that can make you a great investor. This is a market that's full of misdirection. And if you simply trust what the people on television are saying, then you will get singed. This next rule, to paraphrase Public Enemy, is all about helping you to not believe the hype. See, not all upside surprises are worth getting excited about. That's something we hear endlessly, right? Oh, upside surprise, you want to reach for the stock, right? Whenever a company reports its quarterly results and its earnings per share are higher than what the analysts on Wall Street who research the company for a living had on average expected, then all the headlines about the quarter will describe it as an upside surprise. Stocks are supposed to go up when the underlying companies they're attached to deliver higher earnings than anyone had expected. But what the headlines call an upside surprise and what truly impresses the professionals in a quarter are two different things. This distinction can get confusing because sometimes when a company reports an upside surprise for the wrong reasons, its stock will actually go down. For a regular investor looking at the coverage of a quarter, the market probably seems totally arbitrary and capricious after that happens. If an upside surprise can't reliably send a stock higher, then what the heck can? And I'm not talking about situations where management also lowers its guidance, what it expects to earn in the future. At the same time as it delivers higher than expected earnings, then its stock will go down, as that's not really baffling, right? When we buy shares in a company, we care about what it will earn in the future, not what it's already earned in the past. So if they lower guidance, it really doesn't matter what they say about the past. Now, I'm not talking about that kind of confusion. I'm talking about the confusion that results from the headline writers not drawing a serious distinction between a high-quality upside surprise and a low-quality, illusory, almost sleight-of-hand upside surprise. We like companies that can deliver the first kind. But a low-quality, sleight-of-hand type of upside surprise doesn't attract much interest and is just fooling you. Okay, so how do you tell the difference? Simple. One's organic. The other's manufactured by management. A high-quality upside surprise, a real better-than-expected quarter, is generated by higher-than-expected sales, which then leads to better-than-expected earnings per share. Stronger sales could mean a few different things, but they're all good. It could signal that the industry is improving and more people overall are buying a company's product. That's a great indicator when sales are higher that that's happening. Or it could mean that the company's taking market share from its competitors, or that it has growth coming from an entirely new business. So a real upside surprise tells you either that the environment is improved or the company is improved, since both indicate that it should be able to grow its sales and its earnings at a faster clip in the future. And that's a reason to buy, as the big boys in Wall Street ultimately still value stocks based on growth of sales. It's very rare for a stock to go down off of this kind of high-quality, sales-driven upside surprise. Even when we were in the depths of our garden variety depression, these revenue upside surprise stories advanced, as you can see by looking back at Apple's phenomenal run, regardless of the economy, which Apple had produced upside after upside, almost entirely based on much better than expected sales, particularly of the products, the iPhone and the iPod. All right, so what about this low-quality, sleight-of-hand kind of thing? It's easy to tell the two apart, even if the press rarely bothers to draw any kind of distinction. A low-quality earnings beat is based purely on a better bottom line. That's the earnings per share. Better than the top line. That's the sales number. Here, the upside surprise is generated not by improved business, okay? But because management cut costs. Maybe it manipulated the tax rate, all legal, aggressive legal accounting treatment, or maybe it bought back a lot of stocks, so whatever number it reported was magnified by the fact that there were fewer shares. The latter, the bought back stocks earnings surprise, is now regarded as almost totally illusory by market professionals, as the increased earnings per share only indicate a smaller share count, and not profits that were generally better than anyone was looking for. Who does this stuff? You know what? Almost all the food and drug companies often generate sleight-of-hand style upside surprises. When they can't manage the real thing, there's very little true growth in either business. And this is the dirty little secret. The reason the big boys don't care about those so-called upside surprises, even if journalists think they matter, any large enough company with a halfway competent management that's in a predictable line of business, like the food and drug industry, not tech, can almost always ensure that its earnings per share beat the street's expectations, as long as the quarter isn't actually a really bad one. The food and drug names tend to fire a lot of people or use buybacks to generate their earnings per share based upon the earnings per share upside surprise, or they choose to repatriate as much profit as necessary from their foreign markets. The amount is entirely at their discretion to beat the estimates. It doesn't take anything special. It doesn't indicate that things are in any way really better. It just tells us that management is shrewd enough when it comes to making sure its earnings per share number doesn't disappoint anyone. If creating the upside is that routine, then it's really hard to consider it much of a surprise. Here's the bottom line. Now you can tell what the big boys on the Wall Street fashion show want to see in a quarter, and you won't make the confused assumption, like the press does, that the headline earnings per share number is all that matters. A company's ability to deliver better than expected sales counts for a whole lot more than any of those bottom line shenanigans. Stay with Cramer.